It takes us to our talk of the tape, the state of the markets, whether it is time to buy the dip or prepare for more intense volatility ahead. Let's ask our panel. Liz Young-Thomas is SoFi's head of investment strategy. Gabriela Santos is chief market strategist for JPMorgan Asset Management. And Lauren Goodwin, portfolio strategist with New York Life Investments. Ladies, good to have you all here on Post 9. Is the worst over, Liz? Was that it? Was Monday just one of those panic attacks and we've left it in the rear view?
I think it was a panic attack. I don't think it's over. I think this yen thing will resurface again. What we learned this week and what we're learning today is that I think this is the bounce people expected to see on Tuesday. And we tried a couple times. We tried on Tuesday. We tried on Wednesday. Intraday, we got pretty high, and then we gave it all back by the end of the day. So this is the bounce people were waiting for. So now what we've learned is that we're not going to bounce just for bouncing's sake. We need good news in order to move forward and in order to prove that the rally is durable. So today we got some good news, but the interesting part about what happened today is that it was just on that initial jobless claims data. In the trailing 1 year period, this is the biggest move we've had on initial jobless claims data. Suddenly it's important. So that tells me we are even more sensitive to all of the data that's coming in, which also tells me that we're going to see more volatility as we get data that might conflict.
You could, though, Gabriela, say this whole thing really started with one data point, which was overblown, the labor report on last Friday. And then everybody said, oh, my gosh, the labor market's falling apart. We might be closer to a recession than we thought. Fed's going to cut too late. None of it's going to matter because we're going into a recession. Time to sell stocks. And then you put Japan on top of it, and you had a Sunday of madness on Monday morning.
That's right. And I think, as you described, it's a combination of factors, right? Some of them are fundamental. If we think back July 11th with the June CPI that was softer than expected, followed by some additional softer data prints, culminating with the jobs report last Friday. In addition to that, you also had some good but not great mega cap tech earnings that disappointed high expectations. And then you had this really powerful unwind of the yen, specifically carry trade, as you had those interest rate differentials collapse and the volatility double in the yen. So I think it's a combination of factors, some fundamental that were embers, and then some technical that really threw fuel in the fire. So in terms of is the worst behind us, it depends not just on the data, but also how far along we are in that unwind of the carry trade, concentrated positioning, and an unwind of momentum.
It's pretty remarkable, Lauren, the comeback that we've had, because it felt so awful on Monday morning, and it was such a dramatic sell-off. Week to date, the NASDAQ is almost positive. The S&P is almost positive. The Dow is almost positive. I mean, we're less than 1% down on the week for those majors. Now, the Russell is 1.33% negative on the week. But that tells you the story of the rebound. Do you believe in it or not?
I do believe in the rebound because, as you know, I do expect we're slowing towards recession, but the indicators that we use to determine that we're there simply have not been met. We're looking at unemployment claims above the 260 level. That hasn't happened. We would need to see earnings growth deteriorate, where we've had really, frankly, remarkable stability. And so the macro data just doesn't support a story where you see consistent downturns in the U.S. equity market. Now, I think it's very important, though, that the market narrative with that jobs report on Friday has fundamentally changed. That was the jobs report that told us that we don't need to worry about overheating and inflation anymore, and it's a broader deterioration in the labor market that really matters for market activity moving forward. And so bad news is now bad news. Good news is now good news. And I completely agree with Liz that we are likely to get whipsawed around on data until the market resets. And again, I believe that that's when we move closer to recession.